Good morning, everyone. This meeting will come to order. This is a public meeting of the U.S. Commodity Futures Trading Commission. I'd like to welcome members of the public, market participants, as well as those on the phone or watching via webcast. I'd also like to welcome my fellow commissioners, Commissioner Quintens, Commissioner Benham, Commissioner Stump, and Commissioner Berkovitz. Before we commence our official agenda, I'd like to welcome everyone who would like to join us in the Pledge of Allegiance. And today, we are pleased to have with us a very special guest, Caroline Sterling, a second grader who would like to come up with her father, Josh Sterling, our division director, to lead us in the pledge.
States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you very much. Let's give a round of applause for Caroline. Thank you. We'll now begin with opening statements. I'll go first, followed by my fellow commissioners in order of seniority. We gather today to consider two important measures that will improve the regulatory experience for our market participants. In particular, today's actions will enhance harmonization for entities that are duly registered with the SEC and at the same time with us, the CFTC. In particular, we're focused on those entities and people that are registered as CPOs, commodity pool operators, or CTAs, commodity trading advisors. Harmonization is important because it reduces unnecessary regulatory burdens on our market participants. I'm pleased to support both of today's actions and will address each in turn. Before I do so, I want to thank staff in the Division of Swap Dealer and Intermediary Oversight, along with staff from the offices of the Chief Economist and the General Counsel for their hard work in preparing both sets of Part 4 rulemakings. Today's first set of Part 4 final rules adopts CPO and CTA registration exemptions for entities meeting the definition of a family office. The family office is a term the SEC adopted in 2012 for the purpose of excluding such entities from its investment advisor regulations. Family office is basically a private office dedicated to serving the financial interest of a particular family and its members. By definitions, family offices don't solicit the public or the market themselves to the public as an investment strategy or product. So they're not out there soliciting potential customers and consumers. And therefore, they don't raise the same customer protection concerns as do other types of CPOs and commodity pools. Requiring family offices to file exemption claims with the Commission creates a paperwork burden for them as well as us that doesn't provide any meaningful customer protection benefit. The first set of final Part 4 rules also amends two exemptions to permit general solicitation in certain duly regulated private offerings and resales under the SEC's Reg D and Rule 144A. Consistent with the Jobs Act, these SEC rules allow issuers and resellers to market securities without fear of violating federal securities laws as long as the sales are limited to sophisticated investors. Until today, the CFTC, our Part 4 rules didn't account for those SEC regulations. Today's final rule harmonizes two Part 4 exemptions with the SEC's regulations to finally eliminate this inconsistency. That's the first set. The second set of final amendments to Part 4 covers exclusions to the CPO definition for SEC-registered investment companies. Today's amendments provide that exclusions from CPO registration for SEC-registered investment companies should be claimed by the entity that solicits and operates the investment company. That entity is usually an SEC-registered investment advisor. This change will harmonize the Commission's Part 4 registration requirements with the SEC's statutory scheme for investment companies and investment advisors. Making this change to Part 4 will eliminate unnecessary burdens and improve the regulatory experience for asset managers. This second set of Part 4 amendments will also exclude investment advisors of business development companies from the CPO definition. Now, business development companies are closed-end investment companies that make capital available to small, developing, and financially troubled businesses. These businesses may otherwise have trouble accessing the public capital markets. Given their unique role, business development companies, through their investment advisors, use derivatives to hedge and manage risk related to the companies in which they invest. They accordingly create low risk to the market, and our rules should reflect that. Finally, the second set of Part 4 amendments will eliminate certain regulatory filings for classes of CPOs and CTAs. Among other things, the amendment removed filing requirements for registered CTAs that do not direct client accounts and who are already required to report similar information due to being registered in another capacity. For example, if we have a CTA who is also a CPO. Together, the Part 4 amendments will reduce the burdens placed on our market participants by removing certain requirements that are duplicative of those of the SEC, or in other cases, those of us, the CFTC. And now I'd like to recognize my fellow commissioners for their opening statements. Commissioner Quintens?
Thank you, Mr. Chairman. I do not have an opening statement this morning, but I would like to thank DSIO and the staff for all of your hard work and for preparing for today, and I'm very pleased to support today's rule. Thank you.
Thank you very much. Commissioner Benham?
Good morning. Thank you, Mr. Chairman, and thanks to the staff of DSIO. I also don't have a formal opening statement. I'll make some comments a bit later, but look forward to discussing both of these rules. And again, thanks to you for convening the meeting, and thanks to the staff.
Thank you very much. Commissioner Stump?
I would just echo what everyone else has said. Thank you so much. In my opinion, this is about providing regulatory certainty, and I want to applaud you all and the Commission for devoting time and attention to regulatory certainty. I think it is just as important as our regulatory development, supervisory, and enforcement roles. So sometimes it doesn't grab the headlines that it should, but you all should be commended for helping us advance regulatory certainty. So thank you.
Terrific. Commissioner Berkovitz?
Thank you, Mr. Chairman. Again, I'm happy to be here in a public forum where we can discuss these issues openly. I'd also like to thank the staff for their work with my office in incorporating a number of changes into the rules. Unfortunately, not all the changes we suggested were incorporated, and I'm looking forward to discussing those individually. I think while harmonization and clarity and reducing burdens are important considerations for us as we go, as we proceed with our rulemakings, in and of themselves, they're not objectives. Those are just secondary factors. The primary objective in everything we do here is whether our action will improve the regulation of the markets that we're charged with regulating and meet the mandate under the Commodity Exchange Act, not the Securities Exchange Act. We must be primarily concerned with the Commodity Exchange Act. And I think that's what some of the discussion I'm looking forward to will hopefully elucidate. Thank you.
Thank you very much, Commissioner Berkovitz. Okay, so the staff will present today's agenda items to the Commission. Staff will present the two sets of Part 4 final rules together, but the Commission will vote separately on each of the rule sets. After the presentation, the floor will be open for questions from each Commissioner. Following the close of discussion, the Commission will vote on each rule. All final votes conducted in this public meeting will be recorded votes. The votes of approving the issuance of rulemaking documents will be included with those documents in the Federal Register. To facilitate the preparation of approved documents for publication in the Federal Register, I'd now ask the Commission to grant unanimous consent for staff to make necessary technical corrections prior to submitting them to the Federal Register.
So moved.
Second.
Thank you. Without objection, so ordered. Okay, at this time, I'd like to welcome the following staff members for their presentations on the Part 4 final rules. From the Division of Swap Dealer and Intermediary Oversight, we have our Director, Josh Sterling, our Acting Deputy Director, Amanda O'Lear, Special Counsel, Elizabeth Groover, and Special Counsel, Chang Jung. Thank you so much for being here. I will now hand the floor over to you.
Thank you, Mr. Chairman. Mr. Chairman and fellow commissioners, good morning. It's a pleasure, as always, to be here before you today, along with members of the world-class staff and DSIO. I believe the chairman's opening remarks were an excellent summary of the rules we have before you today, so we'll not give any remarks that would replicate those. I will say that these rules we put before you for consideration for final vote are based on an October 2018 proposal we made. We received approximately 30 letters from interested market participants and members of the public. We took all of those thoughts into consideration, and I have to thank as well both each of the commissioners and the chairman individually and their staffs for their input as well as we formulated the rules. And we believe that these rules fully reflect a good balancing of the comments received. So without further delay, I'll hand this over to the expert members of my team, but I do wish in doing so to thank them for the hard work that they did. That includes Acting Deputy Director Amanda O'Lear, Special Counsels Elizabeth Groover, Chang Jung, and Michael Ehrstein. Elizabeth and Chang are with us here today. I also want to note that, as always, the General Counsel's Office was vital to getting these rules properly vetted. Would like to thank Carleen Kim and Mark Pfeiffer for their hard work with us under Dan Davis's leadership. And then finally, Scott Mixon and Stephen Kane in the Office of Chief Economist for their hard work as well. So I'll now hand it over to Acting Deputy Director O'Lear.
Thank you, Josh. Good morning, Mr. Chairman and Commissioners. As the Chairman stated, staff is presenting two final rules today for the Commission's consideration. As we move into the substantive presentations, Elizabeth Groover will be presenting the amendments to Regulations 413 and 414, which add exemptions for family offices consistent with relief provided by the Securities and Exchange Commission under the Investment Advisors Act of 1940. Then, Chang Jung will discuss the amendments to Regulations 4.7 and 413, harmonizing the Commission's regulations with the relief provided under the Jobs Act. Chang will also be presenting the amendments to Regulation 4.5, which clarify the appropriate entity claiming the exclusion with respect to registered investment companies, and add an exclusion for registered investment advisors of business development companies. Finally, I will be discussing the amendments to Regulation 427, which provide relief from the reporting requirements of Forms CPO-PQR and CTA-PR for certain CPOs and CTAs, respectively. I will now turn it over to Elizabeth to begin the substantive portion of our presentation.
Mr. Chairman, Commissioners, good morning. I am Elizabeth Groover, and I work as a Special Counsel and DSIO on the CPO-CTA team. Thank you, Josh and Amanda, for the kind introductions and for your ongoing support on this final rulemaking project. I would also like to thank my fellow team members for their extensive assistance in completing these final rule releases for the Commission's consideration today. As Amanda just mentioned, I will be discussing the amendments that, if adopted this morning, will add exemptions from CPO and CTA registration for qualifying family offices to our Part 4 regulations. I will start off with some background on family offices and describe the current regulatory landscape applicable to them before getting into the substance of the final amendments you are considering today. Family offices are professional organizations that are wholly owned or controlled by clients in a single family. They serve as a wealth management mechanism for such families, providing a broad spectrum of investment management, advisory, taxation, and estate planning services to their family members. The operations of a family office frequently involve the management of pooled assets from a variety of sources within the family. Those sources may include natural persons or family members, as well as entities controlled by the family or an individual family member, such as a charitable trust. These individuals and entities receiving services from the family office are known as family clients. Close familial and personal relationships among the family clients are very common, as are close relationships between the family office staff itself and the participating family clients. For these reasons, Commission staff has historically viewed family offices as distinguishable from the typical arm's-length relationships found between a CPO or CTA and its clients. If a family office invests these pooled assets in commodity interests or commodity pools, or otherwise provides commodity trading advice to its family clients, then it is very likely that the family office would be engaging in activities generally requiring registration as a CPO or a CTA. Therefore, without an exemption, exclusion, or other commission staff letter relief, family offices would be subject to the registration and compliance requirements under the Commodity Exchange Act and our regulations with respect to those CPO and CTA activities. The Securities and Exchange Commission adopted relief for family offices in 2011 in the form of a regulatory exclusion from the investment advisor definition. In providing that relief, the SEC defined family offices as a company, including its staff, that has no clients other than family clients, is wholly owned and exclusively controlled by one or more family clients, and does not hold itself out to the public as an investment advisor. Consequently, family offices meeting that definition may provide investment management and advisory services to persons and entities considered to be family clients without being regulated as investment advisors. DSIO issued staff letters 12-37 and 14-143 to provide no action relief from CPO and CTA registration to family offices remaining in compliance with the terms of that SEC exclusion. Qualifying family offices have been relying on that relief since 2012 and 2014 respectively. In the 2018 proposal, the Commission proposed amendments to add CPO and CTA registration exemptions for family offices to Regulations 413 and 414. In short, those proposed amendments, like the final versions before you today, are consistent with those staff letters. Comments received were overall favorable and supportive of the Commission's efforts to add these exemptions specifically to Part 4. They also responded to relevant questions from the proposal and raised some of their own. With respect to the proposed annual notice requirement, staff recommends today foregoing that filing consistent with the reasons stated by multiple commenters. Staff further believes requiring an annual filing would neither provide meaningful customer protection nor advance the Commission's regulatory mission, given the generally very stable nature of family offices. Not requiring a notice also harmonizes the conditions of relief between the SEC exclusion, the CPO exemption, and its CTA counterpart in Regulation 414. Staff believes, for the reasons stated above, that family offices possess unique characteristics that justify not regulating them like registered CPOs and CTAs who, unlike family offices, do routinely solicit the public for investment. Like all other CPOs exempt under Regulation 413, pursuant to these final rules, family offices will still be subject to identical record-keeping requirements as well as the Commission's special call authority. Therefore, staff believes that the adoption of these exemptions will enhance the widely utilized no-action relief for family offices by providing additional legal certainty in the form of CPO and CTA exemptions in Part 4 without negatively affecting the Commission's regulatory interests. Therefore, staff recommends that the Commission adopt the family office amendments in the final rules before you today. Thank you for listening. I'll now turn it over to Chang.
Thank you for your presentation, Elizabeth. Good morning, Mr. Chairman and Commissioners. My name is Chang Jung, and I am a special counsel in DSIO's CPO-CTA team as well. I'm here to first discuss amendments to two regulations relating to the Jumpstart Our Business Startups Act of 2012, which is more commonly known as the Jobs Act. The two regulations that are being amended are Regulations 4.7 and 413A3. 4.7 is an exemption that provides some compliance relief to CPOs of pools that have only sophisticated investors, whom we call qualified eligible persons or QEPs. The second regulation, 413A3, is an exemption that provides registration relief to CPOs of certain pools that, among other things, engage in a limited amount of derivatives trading. These regulations are being amended in response to the changes caused by the Jobs Act that resulted in a regulatory mismatch between our regulations and the SEC's regulations. By way of background, in 2012, Congress enacted the Jobs Act for the stated purpose of increasing American job creation and economic growth by improving access to the public capital markets for emerging growth companies. Among the various things that the Jobs Act did was amend the Securities Act of 1933 and require the SEC to revise its regulations in order to loosen marketing restrictions on certain types of securities. To that end, the SEC created new Section 506C in Regulation D that allowed issuers of privately offered Regulation D securities to engage in general solicitation and advertising. The SEC also amended Rule 144A, which addresses resales of securities to qualified institutional buyers to eliminate its offering and marketing restrictions. This created a regulatory mismatch with our regulations because our 4.7 and 413A3 exemptions explicitly forbid general solicitation. Prior to the Jobs Act, Regulation D private offerings also forbid general solicitations, but as noted after the Jobs Act, newly created Section 506C, which is deemed to be a type of a Regulation D private offering, allows general solicitation. The end result is that if Regulation D, Section 506C commodity pools wish to operate pursuant to our 4.7 and 413A3 exemptions, they cannot engage in the general solicitation that was explicitly permitted by Congress through the Jobs Act. The public became aware of this issue, and market participants raised this concern to DSIO in part because Regulations 4.7 and 413A3 exemptions are some of the Commission's most widely used CPO exemptions. After considering this issue, DSIO issued CFTC Letter 14-116, which is known within DSIO as the Jobs Act Relief Letter, in September 2014. This granted exemptive relief to CPOs of pools that, on the securities side, are relying on Section 506C of Regulation D, so that if these CPOs engage in a type of general solicitation that was permitted by the Jobs Act in the offering, they may still be able to avail themselves of the 413 and 4.7 exemptions. The Jobs Act Relief Letter also allowed general solicitation in the resales of interest in 4.7 pools in accordance with Rule 144A as amended by the Jobs Act. The Jobs Act Relief Letter did not affect any other provisions of 4.7 and 413A3, so the ban on general solicitation is still applicable with respect to the offerings of all other types of securities listed in 4.7. Also, with respect to 4.7 pools, which are meant only for QEPs, even though a CPO could market interest in these pools to non-QEPs, only QEPs may actually purchase those interests. In 2018, the Commission issued a proposal, part of which amended 4.7 and 413A3 in a manner consistent with the Jobs Act Relief Letter. It also made some technical amendments to 4.7, which reorganized the regulation so that it would be easier for the public to understand. The Commission received 2 comments on this part of the proposal, both of which strongly supported the amendments. After considering these comments, we are not recommending any substantive changes between the proposed rules and the final rules. However, we do recommend further reorganization of Regulation 4.7 in order to more precisely define the scope of the amendments, which will ensure ease of understanding for the public and thereby improve registrant's ability to comply with its terms. In conclusion, staff believes that this is an appropriate effort at harmonization between CFTC and SEC regulations. We believe that it will reduce regulatory friction in a manner consistent with the Jobs Act and provide legal certainty while retaining all of the existing protections for the general public. Thus, given the foregoing, we recommend that the Commission adopt the final rules relating to the Jobs Act that are before you. This concludes my part of the presentation relating to these amendments, and I will now move on to my presentation concerning the amendments to Regulation 4.5. Regulation 4.5 is a rule that provides an exclusion from the definition of a CPO for certain entities that are subject to oversight by other regulatory bodies. There are 2 reasons why 4.5 is being amended. First, it is to clarify within 4.5 that the appropriate person that should be claiming the exclusion from the definition of a CPO with respect to a registered investment company, known as a RIC, is the registered investment advisor for that RIC. This makes sense because the registered investment advisor of a RIC is the operator of the RIC because it is a person that solicits, manages its assets, and otherwise oversees its operations. This is a position that the Commission stated in its 2012 Part 4 rulemaking, and it is a position held by staff and generally understood by industry as well. The issue is, however, 4.5 is currently written in such a way that the RIC itself and not the registered investment advisor is the entity that can claim the CPO exclusion in 4.5. So this rulemaking amends 4.5 to address this inconsistency by making the registered investment advisor the person that may claim the exclusion. The second reason for amending 4.5 is to allow registered investment advisors who operate business development companies, known as BDCs, to be able to avail themselves of the exclusion from the definition of CPO in 4.5 as well. As background, BDCs are companies established by Congress for the purpose of making capital more readily available to small, developing, and financially troubled companies that may not have access to public capital markets or other forms of conventional financing. BDCs are entities that are very similar to RICs. For example, most BDCs like RICs are operated by registered investment advisors. They also have to file 10Ks, 10Qs, 8Ks, and proxy solicitation statements, as well as being subject to periodic examinations by the SEC. In addition, because many BDCs are also traded on national securities exchanges, they're governed by those listing rules as well. Furthermore, BDCs are also subject to certain portions of the Sarbanes-Oxley Act, including the internal control assessment requirement. In short, BDCs are subject to substantial regulatory oversight that is similar to RICs by the SEC. In terms of their use of derivatives, BDCs do not engage in much derivatives trading. And if they do, our understanding is that they just use derivatives to hedge risk by using interest rate and currency swaps. However, despite the similarities between BDCs and RICs, under our current regulations, they are treated differently in 4.5. A registered investment advisor of a RIC that satisfies the conditions in 4.5 is excluded from the definition of a CPO, while a registered investment advisor of a similarly situated BDC is not. This means that the registered investment advisor of a RIC does not have to be duly registered with the CFTC and SEC, while the registered investment advisor of a BDC does. The public became aware of this issue, and market participants raised this concern to DSIO. After considering all the factors that I discussed, DSIO issued CFTC letter number 12-40, known within DSIO as the BDC No Action Letter, in December 2012. This granted no action relief from CPO registration to the operators of BDCs as long as they were being operated similar to RICs that were complying with 4.5. In 2018, the Commission issued a proposal, part of which amended 4.5 to address this situation by amending the rule in a manner consistent with the BDC No Action Letter. The proposal also, as discussed earlier, amended 4.5 to make the registered investment advisor the person that can claim the exclusion from the definition of a CPO with respect to a RIC, and now also a BDC. The Commission received 2 comments on this part of the proposal, both of which agreed with the rationale behind it, but raised logistical concerns regarding the implementation of the proposed changes, in particular, with respect to updating the current notices that have the RIC as the excluded CPO. We considered and addressed all the issues that were raised. Most importantly, though, in an effort to minimize costs and disruption to the affected parties, the updated 4.5 notices for those that have the RIC as the excluded CPO will be incorporated into the flow of the existing notice framework. This means that there will be no need to immediately update the 4.5 notice filings to have the registered investment advisor as the excluded CPO, and there will be no need to make additional filings on top of what is already required under 4.5. As a result, the regulatory texts for the final rules are essentially identical to the proposed rules. We believe that it is appropriate to finalize these amendments because, 1, given our understanding and the public's understanding of how RICs and commodity pools in general are organized, which is consistent with prior Commission statement, it is appropriate to have the registered investment advisor, which is the CPO of a RIC and a BDC as well, be the person that can claim the exclusion from the definition of a CPO. And 2, given the similarities between BDCs and RICs in terms of their oversight by the SEC, it is appropriate for BDCs and their registered investment advisors to be treated the same as RICs and their registered investment advisors so that they can take advantage of the exclusion from the definition of a CPO in 4.5, like other entities that are subject to significant oversight by other regulatory bodies. We believe that this is another appropriate effort at harmonization between CFTC and SEC regulations that will reduce unnecessary regulatory friction and provide legal certainty for the public. In conclusion, given the foregoing, we recommend that the Commission adopt the final rules relating to 4.5 that are before you. Thank you for listening. This concludes my portion of the presentation. I will now turn it over to Amanda O'Leary, who will discuss amendments to Regulation 427.
Thank you for your presentation, Chang. As part of the final rulemaking under consideration today, staff has prepared amendments to Regulation 427, which requires CPOs and CTAs to file forms CPO-PQR and CTA-PR respectively. The amendments remove certain CPOs and CTAs from the definition of reporting person, thereby eliminating such registrants' obligations to file the applicable forms. As background, the Commission adopted Regulation 427 in 2011 and forms CPO-PQR and CTA-PR in 2012. Forms CPO-PQR and CTA-PR collect periodic information from registered CPOs and CTAs regarding their operations and the assets managed by them. Regulation 427 outlines the CPOs and CTAs that are required to file these forms by defining who is a reporting person. Specifically, Regulation 427B defines reporting persons as CPOs and CTAs that are either registered or required to be registered with the Commission under the CEA and the Commission's regulations promulgated thereunder. After several filing cycles of these forms, it became clear that a number of entities were submitting filings on both forms that were largely without usable data. Subsequent consultation with the National Futures Association revealed that these filers were registered with the Commission and as such met the reporting person definition, but did not operate any commodity pools or trade any client accounts. As such, these entities correctly populated their forms with mostly zeros, data which is neither of use to the Commission nor a productive use of these registrants' resources. To that end, DSIO issued several staff letters that exempted certain CPOs and CTAs from filing forms CPO-PQR and CTA-PR. Specifically, these staff letters exempted from filing CPOs that are registered, yet operate only commodity pools for which they are excluded or otherwise exempt from registration, and CTAs that are registered but do not direct any commodity interest accounts. The final rule under consideration today provides relief that is consistent with those letters. In 2018, the Commission proposed amending Regulation 427 consistent with the prior staff relief, and additionally, the proposed regulatory amendments would exclude from the reporting person definition CTAs that registered despite meeting the terms of the exemptions set forth in Regulations 414A4 and 414A5, which provide an exemption from registration as a CTA if that person is also either a registered or exempt CPO, and their commodity trading advice is directed solely to the pools for which it serves as a CPO. The Commission received 2 comments on these provisions in the proposal, both of which were favorable. This final rule under consideration today would adopt the regulatory changes set forth in the proposal without substantive change. Staff believes that these amendments will remove non-productive compliance costs from certain CPOs and CTAs and will increase the quality of the data collected by the Commission on forms CPO-PQR and CTA-PR. Therefore, staff recommends that the Commission approve the final rule amendments to Regulation 427 under consideration today. This concludes staff's substantive presentation on these final rules. We're happy to take any questions you might have, and thank you for your attention.
Well, thank you very much, Josh, Amanda, Elizabeth, and Chang, for that very informative presentation. To begin the Commission's discussion and consideration of these rulemakings, I'll now entertain a motion to adopt, again, via 2 separate votes, the 2 final rules amending Part 4.
So moved.
Second.
I'd now like to open the floor for commissioners to ask any questions. And since in your opening statement, Commissioner Berkovich, you indicated you had questions and comments, why don't you go ahead first?
Thank you, Mr. Chairman. And I thank the staff again, and I think the staff presentation today was a very excellent presentation and demonstrated the complexity of some of the matters that we're dealing with, and your mastery of that complexity is quite impressive, and I think we're fortunate to have such a talented staff. My objective in my comments on going forward on particularly on the family office rule is really designed to ensure that our staff has the information to do its job and to do it well, and that's what it's intended. But before I get into that, there's another issue in the proposed rule that could you explain what the final rule, what the approach is with respect to the aspects of that were in the proposal regarding the offshore pools and the treatment of offshore pools. What is the final approach, is the final rule taking and our intention going forward on that?
Yes, Mr. Commissioner, thank you for that question, and thank you for your remarks as well. The final rule release indicates that the proposed exemption for overseas commodity pools, offshore commodity pools, is being withdrawn as written, and indicates further that that's an area for further analysis by the staff. And we are undertaking an analysis to consider what further actions might be appropriate for the Commission to entertain.
Okay, thank you. I recognize that we did get significant comments that require further consideration by the Commission on that and how to go forward with respect to the situation regarding offshore pools. So I will look forward to staff's recommendations and working with my colleagues on where to go forward on that issue. Let me now turn to some of my concerns on the family office rule. And as I noted, we did meet earlier, and in your presentation, you noted, Amanda, a significant change that staff did make, and that was to clarify in the final rule that the record-keeping requirement applies to exempt family office pools, and that the Commission's special call authority applies. So we do have that same record-keeping authority for these exempt pools as for other types of exempt pools in the regulations, correct?
Yes, so we amended 413C to state that any person who is claiming an exemption under 413 remains subject to record keeping and special call authority.
And fundamentally, and I think at this point I want to take a step back. Again, the staff presentation was excellent and demonstrated, I think, some of the technical complexity, but I think it's also important that we step back and look at the bigger picture here in terms of what we're talking about. We are talking about RICs, BDCs, and CPO, PQR, and all the jargon. But even in the term family office, I think there's some definition and some clarity as to what these entities are. I supported the proposal to exempt family offices from exempt operators of commodity pools and family offices from registration, because I thought the exemption and the proposal were balanced, that the exemptive relief in the proposal was balanced with checks and balances on that relief. And the checks and balances in the relief were, one, a significant check and balance is notice that we know who these exempt pools are. The record-keeping requirement is critical too, but important to our surveillance is if we have exempt pools, I think we should know who those exempt pools are. The second check in the proposal was that persons who were disqualified from registering as commodity pool operators would be disqualified from being exempt, being able to operate in an exempt manner. Disqualified persons were disqualified. That part of the proposal also is not being finalized. Is that correct?
That is correct, Mr. Commissioner. The disqualification point, commenters raised fair issues around procedural protections for disqualification, given how the statute's written. We're inclined to agree that it's an important area, and we're going to continue to work on it so that the Commission can consider further action in the future.
Okay, thank you. So the absence of those two provisions, the notice provision and the disqualification of disqualified persons, to me, make this final rule before us on the family office exemption deficient. Let me also start at explaining this issue so folks can really understand what's going on here about describing exactly what a family office is. The term family office, somewhat benign sounding and term, but it's a family office. It's not really maybe a farmer who has an office managing their commodity interests. Looking at the SEC, who defines family office, this is from the SEC's description of a family office. Family offices are entities established by wealthy families to manage their wealth and provide other services to family members, such as tax and estate planning services. Family offices basically are not for ordinary families who might decide that they're having some commodity interest. These are really for very wealthy families. If you look at the history of family offices, I won't go through the whole thing, but the first family offices in the United States were established by the House of Morgan and the Rockefellers. And the Rockefeller family office is still in existence today, and it's at 30 Rockefeller Plaza, and I think it has something like 1,100 employees. These are mega wealthy, mega rich people who have these devices to measure their wealth. Under the SEC's definition, family offices are not limited to managing the wealth of the related members of the family, but may also include family clients, which includes key employees of the family office, any nonprofit or charitable organization funded exclusively by family members, certain family client trusts, and any company wholly owned by and operated for the sole benefit of family clients. So it can include, a family office can include charitable trusts and companies owned by the family. By any measure, if one looks at who has family offices today, family offices are managing extremely large amounts of wealth. The smallest ones in existence today are managing tens of millions of dollars. And even a family office with tens of millions of dollars is considered small today, and those are increasingly becoming rare. The Global Family Office Report for 2019, put out by UBS and Campton Research, states that about 30% of the family offices have been established since 2010. The Wall Street Journal has reported that since 2011, 36 hedge funds have converted into family offices. It's becoming increasingly popular since 2011, maybe coincidentally since the family office exemption was put into law. I don't know. That would be speculation. But here's what's actually pretty interesting about the Family Global Office Report 2019. According to this report, the average family wealth of those surveyed, about 35 respondents to their survey, the average family wealth of those surveyed with a single family office, those are the types that are exempted today, are 1.3 billion. These are billionaires, 1.3 billion in family wealth and 802 million in assets under management. That's the type of entity that we're talking about. I did a little more research and I found this great resource. This great resource is the Complete Family Office Handbook, a guide for affluent families and the advisors who serve them. And this book looks to be a pretty reputable resource. It's published by Bloomberg in conjunction with Wiley, an academic publisher. All sorts of accolades on the back here. The Complete Family Office Handbook captures the essence of today's family office and paves the way to best practice for every family and advisor entrusted with sustaining generational wealth. Kirby has written what is sure to be an industry classic. That's by Sarah Hamilton, founder and CEO of Family Office Exchange, which is also prominent if you look on the website. The Family Office Exchange has a lot of information. So this, I think, seems to be a pretty credible source. According to this book, it is estimated, quote, that the operating costs to build out a fully functioning family office typically require a minimum in the range of 500 million to $1 billion. If you're going to do a family office these days, due to the operating costs, there's also low interest rates. You got to get a return on your money. You have to hire all these employees to manage your wealth, hire people to be CPOs and investment advisors and all that. It's 500 million to $1 billion is what it really takes to establish a family office today. In aggregate, the amount of wealth managed by these family offices is staggering. By one estimate, the total assets under management by family offices is over $4 trillion. A recent Forbes article noted that, quote, family offices are now capable of making transactions that were traditionally reserved for big companies or private equity firms, and therefore are becoming a disruptive force in the marketplace. Commodity pools are one tool that mega millionaires and billionaires use to manage their wealth in these family offices. Due to the lack of transparency, we don't know what else they're doing. But passage in here indicates there may be some sign for concern. In terms of reduction in tax exposure, UHNW individuals, now this is ultra high net worth individuals, presumably they're in family offices, not all of them, but these individuals seek locations with favorable tax structures. This is particularly desired as U.S. authorities ramp up the fight against offshore tax havens and increase taxes. In response, this is the Family Office Handbook written by an advisor to family offices. In response, American UHNW individuals are searching for new avenues to protect wealth and reduce tax exposure. In particular, they are searching for less visible markets that do not have tax treaties with the United States. They're searching for less visible markets that do not have tax treaties. They don't want to pay taxes and they don't want to be visible. Okay? These very wealthy individuals do not want to pay taxes and they do not want to be visible. And they're looking for tax havens outside the United States to accomplish that. So that's sort of the background, what we're talking about. I don't want to smear, I'm sure there are many individuals in these organizations that pay their taxes, but this is the guidebook, this is the handbook about what the ultra wealthy are doing here. Okay? Now, I understand and can support the exemption and the rationale for CPO registration of the operators of the commodity pools in these family offices. I think the staff has stated the appropriate rationale for this exemption from registration. We don't have the same regulatory interest in the commodity pool operator who's operating the commodity pools for these ultra-wealthy family offices, whether the commodity pool operator and the family members, their relationships is of less regulatory concern than commodity pool operators that solicit the general public. So if they want to, whatever their relations are, I agree we have less regulatory concern. But that doesn't mean we have no regulatory concern in the operation of these pools. These are extremely large amounts of wealth. To date, and currently, prior to the promulgation of this rule, there's always been a notice requirement so that we knew who these CPOs were of these pools and family offices. Under the regulation that was repealed in 2012, whose repeal necessitated the no action relief that we're operating under today, there was a notice requirement. Under the current no action relief, there's a notice requirement. The Commission to date has determined that it's important for us to know who these entities are, who is operating these pools. We have always known that information. The notice requirement is simple. It's almost trivial. The notice requirement that we're talking about that would impose all these burdens on these people is what? Name, send us your name, address, telephone number, email address, and name of the pool. I can fit it on a sticky, and you can email it in. It's an absolutely trivial notice requirement, but it provides us with valuable information about who's operating these pools. All other claims for exemption under 4.13, under all the other pool registration exemptions, they have to file notice. The CPOs of single pools, if you operate a single pool for nonprofit and you don't accept compensation for it, if you're the operator of a single pool and you don't accept compensation for it, you're exempt from CPO registration, but you have to file notice. And that's in our regulation that they're being exempted from today. If you operate a small pool with less than 15 participants in the pool, to a maximum of $400,000 in capital contributions to that pool, you have to file notice. $400,000. If you have less than $400,000 and 15 people in that pool, you have to file notice. But if you have 1,000 times that amount in your pool, 400 million is 1,000 times 400,000. If you have $400,000 in your pool, you have to file notice. But if you have 1,000 times that amount of money in your pool, you don't file notice with us. We're exempting you. That just doesn't make any sense to me. 1/1000th of the pool size, there's a regulatory interest in knowing about you. But if you have 1,000 times that amount of money in your pool or your assets under management, you don't have to file notice. What's the rationale? It's a burden, okay? In the proposal, in the cost benefit and considerations in the proposal, we estimated the cost of the annual notice requirement. It seemed pretty high to me for filling out a sticky, or sending in the email, which is what you can do. But our estimate of the cost of this notice per pool was $28.50. $28.50 to provide this notice. And we're claiming this is a burden? We're claiming this is a burden on mega millionaires and billionaire funds? That this is a paperwork burden for them? I don't get it. I don't get it. I don't see that this is a burden at all. Our interest in these pools is not limited to investor protection. There's also an interest in activities of pool operators in our market. And Congress has stated this, Section 4L of the Commodity Exchange Act, quote, "The activities of commodity trading advisors and commodity pool operators are affected with a national public interest in that, among other things, their operations are directed toward and cause the purchase and sale of commodities for future delivery. And the foregoing transactions occur in such volume as to affect substantially transactions on contract markets." That's what Congress stated. The Commission has a significant interest in knowing who these persons are that are operating these pools, including those that are exempt from registration. And our interest is manifest in the fact that we require notice from everybody else except we require notice from everybody else claiming exemptions. Only the mega millionaires and billionaires are getting an exemption from that notice requirement. The Commission states that eliminating the notice requirement will harmonize the regulations with those of the SEC. Well, harmonization for harmonization's sake is not a rationale. Okay, the question for us is not whether the SEC has determined to do something and we're going to just follow what they do. The question is it the right thing to do? Is it the right thing for us to do? Instead of harmonizing the notice requirement with the SEC's, we should harmonize this notice requirement with all the other notice requirements that we have for all other exempt pools. Why are we harmonizing with them? Why don't we harmonize with us? Be consistent here and not give not make the 1/1000th file, but the 1,000 times not file. My second concern is on the disqualification, or failure to address that issue. As I mentioned, the proposal would have prohibited any person who was subject to a statutory disqualification from registration from claiming an exemption from registration. The logic is simple. A person who was disqualified from operating a pool in a registered capacity should also be disqualified from operating a pool in an unregistered capacity. Disqualified persons should be disqualified. In the proposal, the Commission stated, "The Commission is concerned that it poses undue risk from a customer protection standpoint for its regulations in their current form to permit statutorily disqualified persons or entities to legally operate exempt commodity pools, especially when those same persons would not be permitted to register with the Commission." That's perfectly sensible statement by the Commission in the proposal. I totally agree with it. The National Futures Association also totally agreed with it. They fully support the disqualification of disqualification. NFA's comment letter said, "The Commission aptly states in the Federal Register release that the proposed prohibition would provide a substantial customer protection benefit. In particular, the proposed change addresses a significant regulatory gap in the Commission's exemption framework and will certainly strengthen customer protection by ensuring that a person who may be prohibited from registering as a CPO is not able to operate an exempt fund outside of the Commission's and NFA's regulatory oversight." In today's final rule, the Commission states that commenters raised a number of issues regarding the statutory disqualification provision that require further consideration. I agree, the commenters raised issues that need further consideration, but the Commission should have address those prior to giving today's exemption. Customer protection should be our first priority, not deferred. The Commission should have addressed these concerns prior to granting today's exemption for family offices. Customer protection should not take a back seat to exemptions from regulation for billionaires. And when you put the customer protection, the lack of the statutory disqualification provision together with the absence of notice, we don't even know whether some bad guys are operating. We don't even know whether a statutory disqualified person who would be subject to the regulation if we had it. So we're going totally blind. So the combination of those two approaches, in my view, make the current exemption for family office not acceptable in its current form. And Mr. Chairman, I really think we need notice, and we need to prohibit statutorily disqualified persons from operating exempt pools.
Thank you.
Thank you.
Thank you very much, Commissioner Berkovitz. Why don't we put another 15 minutes on the clock? We'll go now to Commissioner Stump.
I have no questions. Thank you all.
Commissioner Benham.
Thanks, Mr. Chairman. I will pick up on the notice comments Commissioner Berkovitz made. I thought it was interesting and convenient that the commenters responded to a number of our questions, but didn't respond to the sort of time, the question about how long it would take to make a notice filing. And without knowing the exact time, but juxtaposing it against what points I believe Elizabeth made about, and potentially Amanda as well, about preserving customer protections, being consistent with the SEC, preserving our special call authority, the record keeping, and whatnot. I just want to take a step back because there are multiple elements to the notice filing that are important, both as a matter of customer protections, but the way my mind thought about it initially was market surveillance. And given the size of family offices, what, if any, concerns do you have that may exist now that we don't know about who's going to be participating in this office? Obviously, surveillance is a huge element of our responsibility, knowing both participants, the size of the participants, and what potentially market-moving implications those participants could have on the market if something were to go wrong in their portfolio or portfolios. So I guess in your mind, given this decision to not require notice, was there a discussion about the balance between market surveillance, market oversight, financial stability, and providing this notice for the foregoing reasons, consistency and preserving special call and record keeping?
Thank you for that question, Mr. Commissioner. I think that we gave consideration to a great number of points, and my own view is that in terms of market surveillance, that operates at several levels, including at the exchanges and certainly through our own market surveillance and DMO activities here at the Commission. I think those surveillance activities occur as a result of being someone with trading privileges on an exchange, of being active in the market and being required to file a Form 40 report or anything like that. Those requirements apply regardless of whether you're a registered or exempt CPO. In my mind, being a commodity pool and a commodity pool operator is an indication that the relationships between the operator and the pool and amongst the individuals in the pool are so attenuated because of a public offering or a private offering that federal intervention is appropriate. Where it is family and key employees, I suppose, under the SEC guidance, we think that need is less expressed. We think the SEC was right to say that in terms of the vehicle, the vehicle and its management, the right filter there would be a state law or family law at the state level, and certainly contract laws between the key employees and any investments they might make in the same vehicles. And so I tended to view Part 4 and the CPO requirements very much apart from the market surveillance activities. I don't think an exemption here, notice or not, would affect the ability to surveil people that trade on lit exchanges.
Can you talk a little bit about, to the extent you know, what type of disclosures or information is provided to non-family participants in a family office?
Well, Mr. Commissioner, happy to answer that. I will have to confess to not having perfect knowledge on that, but my understanding is that when we're talking about key employees in the context of a family office, they're very much involved in the business, the family office, and its investment activities. And so I think the knowledge base there is quite different from even what you would typically experience in a private offering to very qualified institutional or ultra-high net worth individuals that are professionally advised.
Thanks. So over the years leading up to today, and these facts were articulated in the presentations, we've issued a number of no action letters, interpretive letters, etc. How will today's final rule impact those letters?
So thank you, Commissioner, for your question. Today's final rules will supersede the two particular rules that the two particular letters that DSIO issued. It's letter 12-37 for CPOs and 14-143, thank you, Elizabeth, for CTAs. I know the CPO one much better. I worked on that one. So those two letters will be explicitly superseded by these final rules today. However, over the years, DSIO and its predecessor divisions has issued a number of interpretative letters that are specifically directed to individual entities. Those individual entities are permitted to continue to rely on those letters. This rule does not specifically address or eliminate the relief that was previously provided on a one-off basis.
Thanks. I want to touch on 1896 briefly, the portion that we're withdrawing. Director, if you could just kind of share or shed some light on what this action, how this action will affect future action, and what is your sort of vision for the future, and the idea of withdrawing it. Are we going to have to repropose it? Is it going to be finalized in some other matter or order? I think it's important for those of us for those individuals who don't necessarily focus on the day-to-day of the commission to understand what the practical implications are for that action and what it might mean for the future.
Sure. Thank you for that question, Mr. Commissioner. Happy to answer that. I think the underlying concern with the proposal was that it sort of articulated a viewpoint that was inconsistent with how a number of international asset managers, non-U.S. managers, were regarding their non-U.S. funds as being exempt on the basis that they might need an exemption. So the idea was to withdraw the exemption, to sort of go back to the way we were before it was proposed, and as a proposal, it didn't have any legal effect. It hadn't been final yet. So I think we are where we always have been, and we continue to review this area and are working on recommendations for the commission to take some action here in the area of sort of a non-U.S. manager of a non-U.S. commodity pool. What relief, if any, could they have available to them from registration as a CPO?
Thanks. Mr. Chairman, that's all for me from questions, but I will say that I will support the rules today, but I certainly appreciate the work that DSIO has done, all four of you in the division, working with my staff, incorporating a number of changes that I requested. But as Commissioner Berkovitz pointed out, and as I pointed out in a few questions, certainly the one thing that jumped out at me was the lack of the notice filing. And notice filings are challenging because I think, Amanda, you pointed this out with your comment about the forms with the zeros. We should only collect information that serves a purpose to both the law and our rules. But certainly, given the use of family offices in today's investment management space, and the types of individuals and the types of organizations, I was a little taken aback by that. But I writ large, given the changes that were made and the effort to work with my office, I will support these rules. But I do certainly hope maybe we can work together in the future as we sort of monitor what the lack of a notice filing necessarily means for the agency and how it will affect us and our ability to do our job. I think, as we've all agreed in the past, ongoing oversight and improvements on our rules is paramount. And as we move forward with this, which I know has been a years-long effort, I think by and large these proposals are solid and are positive, but I certainly would hope that we can continue to work on potential shortcomings and continuing the effort to improve the rules so that we strive for the best possible transparency and market protection. Obviously, customer protections are our #1 priority, but market surveillance, financial stability has become incredibly important as well. And if these types of notice filings could be an element to provide that level of information and detail, I think we should reconsider it in the future. So thank you, Mr. Chairman.
I appreciate it very much, Commissioner Benham. Commissioner Quintans.
Thank you, Mr. Chairman. I formerly ran a CPO, and my opinion is that the registration regime for CPOs has never had anything to do with how much wealth the individual owns, but rather to serve as a level of protection for the outside investors of that CPO. We do not require PTG firms to register. We do not require family offices to register. Just because certain individuals have a certain amount of wealth and therefore can afford a team of lawyers in case they fill out forms incorrectly, in my mind, does not mean that they deserve to have to undertake the entire registration regime that is designed for the protection of outside investors. In terms of what is not in this rule, from the disqualification issue, it's my assumption that that does not preclude us from continuing to consider that. It's also my understanding that there are ongoing conversations the division is having with the NFA around this issue because it is somewhat tricky. Is that understanding correct?
Yes, Mr. Commissioner, it is.
Secondly, I have some of my own opinions about how to think about exemptions broadly in both 413 as well as 4.5. I think if we are going to require firms to register with us when they're already registered with the SEC, we need to have more than just a small de minimis amount of activity in those entities to substantiate that dual registration and to force firms into our own registration scheme. And I would note that this rule does not preclude the consideration of those either. So let me move on and just maybe ask a few specific questions with regard to these particular proposals. NFA has a bylaw, 1101, that prohibits an NFA member from doing business with a non-member that should have registered with the NFA. So under the status quo, where there's a family office that is not registered pursuant to no action relief, but should have registered absent that no action relief, how do NFA members know that they can trade with those unregistered family offices without violating that bylaw?
Thank you for that question, Commissioner. Currently, we understand that those family offices are essentially showing their effective claims of the no action relief under CFTC letter 12-37 to those firms to show that they have no action relief effective, making them not required to be registered and therefore permissible to do business with under bylaw 1101.
Okay, thank you. I had a couple other questions, but I think two of them have already been asked. But I'd like to go back to Staff Advisory 1896 quickly. Until the Commission takes further action, can CPOs and offshore pools continue to rely on the existing exemptive relief under Staff Advisory 1896? and Regulation 3.10 with respect to their offshore pools?
Yes, that's correct. 1896 is available, provides two different kinds of relief for registered CPOs with offshore pools. That remains available, of course. And the Rule 310 exemption itself, which is for offshore pools that can be exempt, because among other things, they have an offshore operator and they trade in the United States on a cleared basis where required. And that remains on the books as well.
Okay. I'd like to thank you all again for your work on these important issues, and I'm very pleased to support it. Thank you.
Thank you very much. I just have two questions. One is a big picture question, one's a technical question. I'll go with the technical question first. I note that we're on the family office issue, we're providing relief through registration exemptions as opposed to registration exclusion. And I think, Elizabeth, you may have said that the SEC actually created an exclusion from their rule, but we're doing registration exemptions. Is there any reason for that distinction?
Thank you, Chairman. Yes, there is. You'll also note that Chang discussed Regulation 4.5, which provides an exclusion from the CPO definition for the operators of certain pooled vehicles, and the entire basis for 4.5 really is because those entities are otherwise regulated, and in the context of family offices, that's really not the rationale for granting relief. Our staff recommended rationale is basically that family offices do not solicit the public. And so we believe that a registration exemption under 413 matches that rationale better than an exclusion, which is really intended for kind of heavily regulated entities.
Great, thank you. And then the big picture question is just simply pretty much everything we're doing today derives in one form or another from the Jobs Act, which was a bipartisan piece of legislation signed into law by President Obama. Is that right?
Thank you, Mr. Chairman. The Jobs Act is the Jobs Act is clearly providing the statutory justification for the amendments to 4.7 and 4.13 when it comes to the modifications with respect to the ability to solicit the public generally, provided that you only sell to QEPs. However, the family offices exclusion that the SEC adopted was pursuant to Dodd-Frank. And so our incorporation really is being driven by Dodd-Frank in that respect. And the CPO PQR is just based on our own experience of our own forms.
Okay, that's very helpful context. I appreciate that. Are the commissioners prepared to vote?
I just had a follow-up question on that
Sure.
answer. But Dodd-Frank didn't direct the CFTC to exclude family offices.
No, it did not.
Thank you.
But it directed the SEC, is that right? Okay.
Yes, sir, it is.
All right, now with that, are the commissioners prepared to vote? Okay. If so, Mr. Kirkpatrick, would you please call the roll for the first set of Part 4 final amendments?
Thank you, Mr. Chairman. The part of the motion now before the Commission is on the adoption of final amendments to Part 4 pertaining to commodity pool operator and commodity trading advisor registration exemptions from SEC-registered family offices and Jobs Act entities. Commissioner Berkovitz.
No.
Commissioner Berkovitz votes no. Commissioner Stump.
Aye.
Commissioner Stump votes aye. Commissioner Benham.
Aye.
Commissioner Benham votes aye. Commissioner Quintens.
Aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Aye.
Chairman Tarbert votes aye. Mr. Chairman, on this part of the motion, the ayes have 4, the noes have 1.
Thank you very much. The ayes have it, and the motion to adopt the first set of final Part 4 amendments is hereby approved. Mr. Kirkpatrick, will you please call the roll for the second set of Part 4 final amendments?
So the part of the motion now before the Commission is on the adoption of final amendments to Part 4 pertaining to commodity pool operator registration and reporting requirements for SEC-registered investment companies and business development companies. Commissioner Berkovitz.
Aye.
Commissioner Berkovitz votes aye. Commissioner Stump.
Aye.
Commissioner Stump votes aye. Commissioner Benham.
Aye.
Commissioner Benham votes aye. Commissioner Quintens.
Aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Aye.
Chairman Tarbert votes aye. Mr. Chairman, on this second part of the motion, the ayes have 5, the noes have 0.
Thank you very much. Well, here again, the ayes have it, and the motion to adopt the second part of Part 4, final amendments, is hereby adopted. Before we move to closing statements, is there any other commission business? Okay. I would like to note that we had originally also planned to address some proposal for Part 50 clearing requirements. We're making some final tweaks among the commissioners, and so we would hope to produce that soon. I was afraid that this would be just too slim of an agenda, but I've been proven wrong. Obviously, these Part 4 rules have generated quite a bit of discussion, robust discussion, and therefore deserving of their very own meeting. Hearing no other official business, I'd now like to give my fellow commissioners an opportunity to make closing statements. We'll start with you, Commissioner Berkovitz.
Thank you, Mr. Chairman, and I thank you again for providing the forum where we can have these robust discussions. I believe they're beneficial and serve to inform the public about the important activities of this agency and provide transparency to our markets. In terms of, you mentioned the agenda going forward and other things that we will be doing in the near future. I just want to reiterate the comment that I made earlier, that what we're trying to do in terms of clarity, transparency, simplification, I generally support those as objectives that we should consider in our rulemakings, and if there is a way to simplify our rules and make them more cost-effective for our registrants, I think we should be doing that. At the same time, those aren't the objectives in and of themselves. Just to make something simple does not provide a benefit. It's something that's beneficial. Can we simplify it? And can we simplify it in a way that still retains the benefits? I believe we have to consider the objective of what we're doing, not just whether it's clear or simple or harmonized with the SEC. So that is going to be the lens through which I look at all these rules going forward. Does it really advance our mission to protect our markets and to foster innovation and transparency and benefit our market participants in competition? Those are the objectives, and if we can achieve those objectives in a simpler way, I'm all for that. But just for harmonization's sake, the SEC may do something doesn't necessarily mean we should be doing the same thing. Thank you, Mr. Chairman.
Thank you, Commissioner Berkovitz. Commissioner Stump.
I just wanted to say again, thank you. Simplicity is not the objective, but it is certainly not the obstacle. We don't want to put in place obstacles that make it difficult for members of the industry or members that or participants of the market to, in fact, find it more challenging to utilize these markets that have a very valid purpose. So I agree with Commissioner Berkovitz. Simplicity is something that I commend you all for trying to achieve. I may not agree with Commissioner Berkovitz on the notion that the information we take in always, in this case, when we talk about the notice requirement, has a utility. I talk about this often, the utility of the data that we take in. I just want to ensure that it, in fact, is useful to the staff and the commission, and I'm not certain in this case that I find it to be particularly useful. Contrary to that, or in contrast to that, I think we did find utility in continuing to have the notice filings with regard to CPOs for BDCs. And so I also want to leave everyone with the impression that I'm not opposed to taking in information. It just needs to have a real use case behind it. But again, I want to commend you all because for me, these rules are about regulatory certainty. And I think that's how we develop a culture of compliance. If we can make regulatory certainty first and foremost an objective of everything we do, then the market participants, by and large, want to comply. And so it makes a culture of compliance more achievable. So thank you all very much.
Thank you very much, Commissioner Stump. Commissioner Benham.
Thanks, Mr. Chairman. Thanks a lot to all four of you. Again, great presentations, great work. Like I said, can't thank you enough for working with my staff and throughout these few weeks as we prepared for this morning, making what I thought were smart changes to improve the document, I think across the board for all of us. True sort of manifestation of the benefits of commissions, right? And having robust discussion and thought build the best product on the back end. With that said, not perfect, as I stated earlier, and I certainly look forward to working with all of you and you, of course, Mr. Chairman, in the future as we implement these new rules to ensure that they're working appropriately, properly, fulfilling our mandate under the Commodity Exchange Act, and ensuring that the markets remain stable, safe, and transparent for customers. And if we do, in fact, need to make future changes, I'm sure we can come to an agreement on what would be a thoughtful, surgical, targeted improvement as we move forward in the future. Thank you.
Thank you very much, Commissioner Benham. Commissioner Quintans.
No closing statement, Mr. Chairman. Just again to thank the staff for their hard work and on these particular issues, as well as broader ongoing efforts to rethink Part 4. Generally, looking forward to a lot more conversations in the future.
Thank you very much, Commissioner Quintans. And let me also, on behalf of the rest of the agency and as chairman, thank DSIO in particular, those four of you that have come today for your outstanding work. And I also obviously want to thank the General Counsel's Office and the Office of the Chief Economist for making this set of rules possible. The only thing I want to say before I officially adjourn the meeting is that I want to wish everyone here at the CFTC, as well as those we regulate and other market participants, a very happy Thanksgiving. With that, there being no further business, I'd entertain a motion to adjourn the meeting.
So
Those in
moved.
favor?
Aye.
Opposed? The ayes have it, and the meeting is hereby adjourned. Thank you.